50% of capital. So capital will include even a preferences. The problem is that if you or some investor is holding major preferences, majority of preferences, then although it may not be holding equity or may not be holding enough equity, there will be a consolidation which will be applicable. Take this case where equity capital is 50 lakhs and the investor is holding only 10%. So generally if you will take AS 21 will not get applied. Even AS 23 and 27 will not get applied. But by in the new Companies Act, because you have to consider a full capital, then this company has to consolidate because it is holding 60% of a preference capital. So overall they will be holding around 54% of the total capital. Okay. So here consolidation will be applicable. Now the thing here is that at the year end you do not have a control because the preference as capital is also gone. So whether the consolidation should be applicable or not, the consolidation still will get applied because of the standard, which standard says that if during the year for certain period you have a subsidiary, to that extent you need to prepare your P&L, take the profit and loss up to that extent. So standard will get applied till the time the preferences gets ready. But what you will consolidate finally will be only on the basis of a 10%, because balance 90% will go as a minority interest, right?
If we don't have any interest in equity share, only preference share, and the preference share in 100% preference share is 60% of all.
Correct.
Then I do not need to consolidate.
Then you need to consolidate as per this.
I have to consolidate, but if I use AS,
yeah, then you have to apply S21. Then it will be same. It will be same accounts. So that is where I was just saying earlier also. That situation may arise.
So, say I have 1% of stake, and I consolidate, and so 99% is minority interest. But if I have 100% but I have 0%, I will not consolidate. Whether I can consolidate and show 100% is minority interest?
No, that is where I am saying that if you have, let's say, 1% interest, you will not apply AS21. Why should you apply AS21? Because as per AS21, it is not a subsidiary. So you will apply associate accounting. So you apply equity method accounting. Otherwise, it is difficult.
No, but in subsidiaries, it's a subsidiary. So as per Companies Act, it's a
So as per Companies Act, it is a subsidiary,
yeah, so
not as per the definition of accounting
yeah,
standard.
so let's say I go to 21, and then for accounting purpose 21, I will account only for 1%, and 92% I will show as minority stake. And similarly to the 100%, I will show 100% minority stake.
That is also possible, but I will not advise that. That is what I am saying. That you have to take provisions that accounting standard will prevail. So definition of subsidiary in AS21 will prevail. I am taking that.
So then that is the case. Then if I am having only associate, then I need not consolidate. Only associate.
Yeah, then you consolidate as per AS23.
Yeah, then I'm doing as
Yeah, so that is what I am saying. Because otherwise, take a case that you have a 1% interest, but you are consolidating 100% revenue.
Yeah.
And then 99% you are taking out. So unnecessarily you are just showing a different picture. So that is avoidable. But yeah, there is a view that you can do that also. That 100% line by line you take and 99% you take it up.
There is no clarity in that.
There is no clarity, but I will prefer the first one because the Companies Act gives that option. Another thing is that there will be a change where what we have find is that certain notes are not dealt with in the consolidated financial statements, but now Companies Act says that it has to be in same form and manner. So whatever in a separate financial statements, in whatever you are disclosing, whatever disclosure as per the accounting standard which is required, the same thing needs to be disclosed in even the consolidation. I'll tell you, a lot of people were taking a shortcuts, mainly in case of a AS15. Because if you look at in AS15 employees benefit, you require a lot of disclosures. So in a consolidation, a lot of people were not disclosing. But now that disclosure will become necessary.
Sir, in case of AS15, if I have a good company and everyone has done their actuarial, so should I have to show it all the actuarial valuation, or should I club it in one actuarial valuation?
Actually, if you have a smaller companies, then I think you should club it. And then if you have a different assumptions applied, let's say,
Okay.
you can give a range. Because there is, but if it is a large subsidiary, I think it is better to consider it separately. So whatever is given, because you know, a lot of things will get changed. But in a smaller thing, I think you can just combine it. And most of the people today are combining, whoever is disclosing. Associate definition also, the one change which is there is that when Ind AS and IFRS will come, there is a rebuttable proposition. If you are holding more than 20%, but if you can demonstrate that you are not participating in the decision making of that company, then in that case it will not be treated as an associate, which today you go just by a 20% holding and a significant influence. So if you can demonstrate that you are not having a significant influence, then you can come out of that and you may not consider that as an associate. A slide on reopening and revision of financial statements. There is a provision in IFRS. However, that is different for the restatement of accounts. Here, it has been built in two manners, that there is a mandatory revision which will be told to be done by regulator. So here it is a tribunal, because somebody has complained and it has been proved, let's say, by a body that the accounts were wrongly prepared, you will be forced to revise your accounts. So that is dealt with under section 130 under the order of the tribunal. Second one is that even a voluntary revision is possible under section 131, where the voluntary revision is possible. However, you need to take approval of the tribunal. You need to go to the tribunal and say that I had prepared a wrong accounts, and that is why I am voluntarily revising my earlier accounts. Now that is different than what is contemplated in IFRS. IFRS and our Ind AS basically says that if you are applying any retrospective application of any accounting policy, then you need to compulsorily, mandatorily revise your earlier accounts which you are giving by way of previous year. Also, you need to, if you have done an error, a major error, then you need to give the impact of that in earlier years. So that's what they call it as a revision, which is different than the revision which has been contemplated in the Companies Act. Okay, the problem will be when Ind AS will come, whether you will be able to do this restatement, because there is no provision in the Companies Act to do such type of restatement. So that every time whether you will go to the tribunal and ask for the revision or not, just to comply with Ind AS. So I think there will be clarity which will be required for that. Another major change which is coming up is in fixed assets and depreciation. Companies Act provides the fixed asset to be taken on the basis of the componentization of the assets. It means that your major plant or major asset can be divided into a different component, and each different component you treat it as a separate asset. So what will be the implication? If you will treat each as a separate asset, there can be a useful life of each that component will be different. And on that basis, you do your depreciation. When you replace that component, on that basis, you apply your accounting standard, AS10. Right? So that's another major change which is coming. However, one thing which is which also is going to change once Ind AS will get introduced, and which has been provided in the Companies Act, you have to keep that in mind. At present, all the companies, if Ind AS is not introduced, let's say from in the current year, all the companies need to provide depreciation on the basis of Schedule 2, which is different, totally different than the Schedule 14, which is at present, which is there. The rate of depreciation in Schedule 14 are not at all in line with what is provided in Schedule 2. Schedule 2, first of all, provides only a useful life. It doesn't provide the depreciation rate. So what will be the impact of that? The impact of that is that under Schedule 14, you are it is assumed that your residual value at the end of the life will be 5%. Here you will be able to assume that your residual value at the end of the useful life of that asset can be 10%, 15% or 5%, 2%, whatever. So that you have to estimate, and on that basis, only on the balance you have to provide a depreciation. But the depreciation rate will be higher because the useful life which has been there in Schedule 2 is much different, much lower than the rate which has been given. So you have to be ready that your depreciation charge in some cases will become double. So you have to keep that in mind.
Is it applicable for next year or for March ending 2014?
It will be from 1st April 2014 now it will get applied.
Next accounting year.
Yeah, because Companies Act is getting will be applicable from 1st April 2014.
One clarification about this office premises, the residual value, how do you capture? Because value is going to appreciate in a city like Mumbai. And the useful life, so you cannot segregate the value of land component and the building component when there is office premises. So it is a case, maybe a case of reverse depreciation, or how do we take?
Yeah, so there are going to be challenges there, but see, as you are rightly saying, there is a land and building portion both.
Yeah.
I think you need to segregate in a proper manner, and building only you have to then take it. But the structure also you need to see that, because if there is a cooperative here in Bombay at least, there is a structure of cooperative societies.
Yeah.
So you are the owner of the land or not, that itself is a doubt.
Yeah.
So you need to look at from that angle. But yes, as you are rightly saying that, but building will get depreciated.
So we need to take two components of that.
Wherever it is possible, wherever it is
An FSI component is there.
legally
building
possible.
component.
Like in South, there is a you are the landowner also.
Two parts.
So there are two parts, so that you will be able to do that. But the thing is that if you will start doing that,
Yeah.
you need to keep in mind in income tax also it will be treated in a similar way.
Yeah, this is it. Yeah.
So,
So
so it's not that.
Not gone to the official's mind.
Yeah.
That this is the reality actually.
Correct. So when you are doing yourself,
Yeah.
I think you need to look at it, because you will not be allowed depreciation otherwise on that.
With this new Schedule 14 coming into place, so new Schedule 3 coming into place, the preparation Schedule 2.
Yeah.
So how do we deal with this particular?
No, so you can say that I am today what I am interested in is occupying the space. So I am treating most of that as a building. So you are taking as a building which you are today doing it.
Yeah.
So I think it is better to take that view. But that is what I am saying, that once Ind AS comes, so what it says is that the Companies Act says that certain companies, when Ind AS will be applicable, at that time they don't have to follow schedule. So again there will be a change at that point of time which will come. But it will be there in line with IFRS. For a securities premium. Here there is a chart for a prescribed companies, which prescribed class will be also either a list, it will be a listed company, and where maybe Ind AS will be applicable. At present, a lot of companies are using that premium for giving a preferences, bonus preferences, which will be not be allowed, only for certain class of companies. Writing of preliminary expenses people are using, which that also will not be allowed. For writing of preference debenture issue expenses, because on the ground that section 78 allows, and the New Companies Act also allows writing of like that, but not of the preferences and debentures issue. Because you are treating debentures as your debt, so any expenditure relating to that you should take it into the P&L account, and you cannot adjust from the reserves. Another major one is that providing for a premium payable on redemption. FCCB issue, there is a premium payable, that premium payable gets adjusted from a security premium, and you say that I am getting a date at 1%, 2%. In fact, it is just the eyewash, because what you are charging it and adjusting in a securities premium, you are not taking that. So once you will take that, it will be at least 5 to 6%. So that will not be allowed, and it will get reflected then in the P&L. Mergers and acquisition, the standard has to be in line with accounting standards, that is what it says. But as I was mentioning, that there is a large gap between the merger acquisition standards internationally and here. So at present people are applying AS 14. With the introduction of Companies Act, you need to mandatorily apply AS 14 for merger. People are taking a stand that for acquisition that standard will not be applicable, then there is no standard, there is going to be an issue. Today also there is an issue. Plus there is a further complication, because what Companies Act is saying, that for a demerger you need to follow 219AA provisions for accounting. Now 219AA provisions is for the income tax. If you want to take income tax benefit, then you need to follow accounting in a certain manner. So here now it is become mandatory that even if you don't want to take benefit of the income tax, carry forward losses and other benefits, still your accounting has to be on the basis of 219AA. And I think most of you may be aware that 219AA says that all the values have to be on the basis of the earlier carrying value. So that's going to be a major issue. And what I think they have presumed is that no accounting standard is today dealing with the demerger accounting, which from that angle no standard is dealing even with the acquisition accounting. So that is where is the problem. They have gone on that presumption. Even after introduction of Ind AS, we may have some problem if this will remain here. But I think you should take a stand that mergers and acquisition also considers a demerger, because demerger for another company it will be an acquisition. So for a demerger also you will apply the same thing. So you will apply basically a fair value account. You can take that stand. Okay, another thing which I want to mention is that, as I was mentioning, there is a major change in the acquisition accounting and even in a merger accounting, because IFRS 3, previously merger accounting was allowed on the basis of a pooling of interest method, and even in case in a fair value method in certain circumstances in IFRS. With the introduction of IFRS 3, pooling of interest method is not at all allowed unless it is a merger of the companies under the same control. So if two subsidiaries are merging, where the parent company is saying, there only you can apply pooling of interest method. Otherwise, you need to compulsorily apply a acquisition method of accounting. So you need to allocate the consideration to a different assets and liabilities which you are acquiring.
So what is the difference between the two? Because pooling of accounts and acquisition method.
Pooling of interest will be on the basis of the cost methods. You will not change any carrying value. And in case of a acquisition method, you will replace your carrying value with the fair value, which is as of the date of merger. So that's a major difference. And we are saying, I just want to highlight that, which I have highlighted in some different forum also. Today we are saying that goodwill on consolidation, which arises because you are acquiring certain companies. So when goodwill on consolidation arises, you say that I am following, because there goodwill on consolidation is not dealt with by any of our standards. Okay? It's not a goodwill, but it is a goodwill which arises only on consolidation. Let's take a case where there is a net worth of 1,000 and you are acquiring that company at 10,000 rupees. So what basically our consolidation standard says is that 1,000 rupees will be shown as an asset and 9,000 rupees will be shown as a goodwill on consolidation. Okay? Then the industry and the company argues that I am now following the international accounting standards which says that goodwill on consolidation is not required to be amortized. So I will only test it for impairment. So most of the companies, including the larger companies, it will be worth studying that for certain companies, goodwill on consolidation becomes 40 to 50% of the total asset of consolidated asset. So that particular thing is not getting amortized. The idea is that if you have paid something, then it should get amortized. That implication is there in international standards because there you are applying a fair value method of accounting. So what will remain as a goodwill will be only a minuscule amount of the total consideration which you are paying. And that smaller portion, you are saying that I am not billing and not doing the amortization. So take an example. Consideration is 1 lakh. In Indian GAAP, what you will do is that the asset value which is 50,000, which is the carrying value, you will take it at that, don't change that. Liability is 10,000, so totally 40,000 is coming in your books as asset and liability.